Hey all, welcome to Share Trek. This is Raj here. I hope you guys are having a great weekend. I enjoyed this Friday and I'm looking forward to the next week. But I have got a lot of yard cleaning to do. The weather is improving out here in Toronto and there's a lot of pine needles in my backyard which I need to clean up. So I'll do that tomorrow. But for right now, this video is about credit rating agencies and analysts. I had been agonizing over this for a while and I thought I'll share my thoughts with you. How much can the retail investor rely on analyst ratings? When the rating comes for free, is it just to move markets or can you depend on it? And on the other hand, if you pay for the ratings, like say you subscribe to a website that gives you ratings, does that mean that it's a sure thing? How should an investor protect oneself in this market? I share some of my own thoughts on these matters and I would like your feedback in the comments below. Once you have done watching this video, please watch it till the end so that you can share your thoughts with me and we can become better all together. So let's get started. Welcome back, my friends. As an investor, it's important to understand that credit ratings issued by ratings agencies should not be seen as the investment ideas in themselves. These ratings should only be used as some kind of a supplementary information as they have failed us in the past to predict the financial crises that came and went, and people have burned their fingers. In 2007 to 2008, you'll recall that it was called the Great Financial Crisis or GFC. The American subprime mortgage crisis triggered the Great Recession of 2008 to 2009. One of the major factors contributing to this particular crisis was the role of credit rating agencies. These agencies rated debit instruments and securities according to the debtor's ability to pay lenders back. However, they gave higher ratings to many of the complex securities used to finance subprime mortgages, which couldn't have been sold without these ratings. And this led to a large section of the debt securities market, including many money markets and pension funds investing in risky securities that were later downgraded to junk status. This caused the collapse of three major investment banks and the federal government buying $700 billion of bad debts from distressed financial institutions. And there has been documentaries about the TARP scheme and it has been dramatized with behind closed doors scenes, etc., etc. You can see those on video somewhere on YouTube. But suffice to say, it cost $700 billion of bad debts from distressed financial institutions to cause that recession. Recent events like Silicon Valley Bank crisis have once again highlighted the limitations of credit rating agencies. For instance, Moody's gave the lender an A rating just 6 days before its collapse, and KPMG signed off on its audit just 14 days before it went bust. This poses a critical question for investors who rely on such reports. If ratings formulated by experts after detailed study can miss details about a company's impending failure, then how can investors gauge the financial health of these investment instruments? Remember, these big rating agencies have employees, analysts who are from top business schools, and they are putting their so-called bright minds to come up with models through which they run all the scenarios and come with the ratings and their recommendations. The failure of rating agencies to identify impending financial crisis is not a new phenomenon. Lehman Brothers, the infamous poster child of the 2008 subprime mortgage crisis, was given an A rating by S&P rating agency just 6 days before its collapse. This highlights the need for investors to exercise caution and not rely on credit ratings when making investment decisions. Investment banks also paid handsome fees to the rating agencies to obtain desired ratings, which the Financial Crisis Inquiry Commission found to be a major factor in 2008 financial fallout or the 2008 collapse. The crisis triggered by SVB's fall shares some of the similarities with 2008 financial crisis because Moody's had rated SVB A just 6 days before it collapsed. The actions of rating agencies can often be misleading for investors, at times even deliberately when it comes to the stability of financial instruments. This has many times led to some hefty losses for investors, especially retail investors. For example, in 2017, Moody's agreed to pay $864 million to settle a multi-year investigation by the US Department of Justice and 21 states over the company's ratings of mortgage-backed securities in the lead up to the 2008 financial crisis. Moody's was accused of inflating ratings for securities that were ultimately worthless, which misled investors and contributed to the financial crisis. The settlement represented the third largest payment ever made by a credit rating agency, after S&P's $1.375 billion settlement in 2015 and Moody's own $1 billion settlement with the SEC in 2011. Mortgage-backed securities are investment products that are created by packaging a group of individual mortgages together into a single security. Investors can buy shares of this particular security, which represents a portion of the underlying mortgage payments. The income from these payments is then distributed to the investors in the form of interest payments. Mortgage-backed securities, or MBS, were widely used leading up to the 2008 financial crisis. At that time, lenders were giving out mortgages to people who were not financially qualified to take on the debt. These mortgages were then bundled into mortgage-backed securities and sold to investors who believed they were safe investments due to the perceived safety of the underlying assets. However, when the housing bubble burst and the home values plummeted, many borrowers defaulted on their loans and the value of the MBS dropped significantly, causing widespread losses for investors and contributing to the global financial crisis. After the crisis, MBS became less common as regulations were put in place to prevent the same level of risk-taking that occurred before the crisis. However, MBS are still used today, albeit with more stringent requirements and oversight to prevent a similar crisis from happening again. Another such investment is the synthetic collateralized debt obligations, or SCDOs, which are at the center of the Australian lawsuit against S&P. SCDOs are complex financial instruments that are designed to transfer credit risk from one party to another. Essentially, they are securities whose value is derived from the value of other securities, such as mortgage-backed securities, and SCDOs were created by US investment banks and were sold to investors around the world. Local councils and pension funds in Australia were among those who invested in SCDOs rated by S&P and lost money when the US subprime mortgage crisis hit a decade ago. During the Australian case, lawyers for the local council accused S&P of weakening its risk assessment criteria to win business and turn out high ratings on opaque debit products. S&P defended its actions, stating that it designed and assigned ratings in accordance with well-recognized international practice and Australian regulations. In the end, S&P settled the class action lawsuit, likely protecting the agency from suits from other investors because legal avenues have now lapsed. A finding of wrongdoing against the agency in Australia could have reopened legal avenues to pursue S&P over its role in investment losses incurred during the financial crisis. The actions of ratings agencies, such as giving inflated ratings to complex financial instruments like SCDOs, have contributed to financial crises in the past. As such, it's important for the investors to be aware of the potential risks associated with such investments and to thoroughly research and understand any financial instruments before investing in it. Therefore, as a retail investor, it's essential to me that I do my own research and analysis on the financial health of a company before making any investment decisions. I don't solely rely on credit ratings, as they are often not foolproof and have failed in the past, leading to significant financial losses for retail investors. As a retail investor, it's I think my personal responsibility to do my own research before I invest. There is no shortcut and there is no sure thing in the market. Our mind is strangely tuned to look for confirmation bias, and there are YouTube channels that focus on specific shares and constantly evangelize on the positives of those shares. You need to constantly make sure that you are not falling for confirmation bias. On my part, I always make it clear that my opinions are mine only and not financial advice. When a retail investor listens to someone else and invests, they do not understand the thesis and the moving parts that are behind it, and therefore are most likely to lose money, since the market is dynamic and the initial thesis can fluctuate between viability and futility very quickly. Basically, check our greed and not buy things that you do not understand is the maxim that I would hold out. Do not put all your eggs in one basket. Diversify is another maxim I would hold out. Well, that's all from me at this point of time on this editorial. I hope you guys found something of value out here. And I also look forward to your sage advice, because many of you have experienced this market. Many of you have made good money in the market and also lost big time. So please put your comments below so that the rest of the community can learn from your experience and get your wisdom. Again, as always, press like and subscribe. And also you can use the super thanks feature to financially support the channel if you really like this segment. Thanks and have a great day. Bye for now.